If you want to stop depending on a paycheck, you have to understand something very basic that most people never slow down long enough to study. A paycheck is not freedom. A paycheck is a trade. You trade time, energy, attention, stress, health, and part of your life for income. There is nothing wrong with that. Work can be meaningful. Work can build discipline. Work can create value. But if the only way money comes into your life is by you showing up every day, then your financial life depends on your ability to keep showing up. That is a fragile system. The goal is not to become lazy. The goal is not to escape contribution. The goal is not to imagine that money appears from nowhere. The goal is to build assets that produce income whether you are actively working that hour or not. That is the difference when you have a job. The income stops when the labor stops. When you own income, producing assets, the income can continue because the asset is working. That is the principle. If you earn $80,000 a year from your job and you want to replace that paycheck, then in simple terms, you need roughly $80,000 a year from assets. Before considering taxes, inflation, lifestyle, healthcare, emergencies, and personal needs. Most people do not like hearing that because it makes the problem real. They want a shortcut, they want a trick, they want one investment that changes everything quickly. They want passive income before they have capital, skill, discipline, and patience. But the world does not work that way. Income-producing assets require money, sacrifice, risk control, and time. Sometimes they also require effort, education, management, and emotional maturity. The more income you want, the more serious you must become. That is the part people miss. Replacing a paycheck is not one decision, it is a system. You need to earn money, you need to save money, you need to invest money, you need to choose assets that produce cash flow, you need to understand the risks inside each asset. You need to reinvest for long enough that the income stream becomes meaningful. And you need to avoid destroying the system with impatience, leverage, or ignorance. This is why most people never do it. Not because it is impossible, because it is slow. And most people are not defeated by complexity, they are defeated by impatience. The good news is that there are several types of assets that can help replace a paycheck over time. They are not all equal. Some are easier, some are harder, some require less work, some require more skill, some are safer but produce lower income. Some can produce higher income but carry more risk or responsibility. The mistake is believing that one of them is the answer for everyone. That is not how I would think about it. Each asset is a tool. A good financial system uses the right tools in the right proportions for the right person at the right stage of life. The first and simplest income-producing asset is lending money to the government through Treasury securities. When you buy a Treasury bill, note, or bond, you are lending money to the United States government. In exchange, the government pays you interest. The income is generally predictable, the credit risk is low relative to almost anything else denominated in dollars. And the interest is generally exempt from state and local income taxes, though federal tax still applies. That makes treasuries useful for people who want relatively stable income without taking equity market risk. But the important word is relatively. Nothing is risk. Free in an absolute sense. Treasuries are backed by the U.S. government's ability to tax, borrow, and, through the broader monetary system, operate in the world's reserve currency. If the U.S. government failed to pay its obligations in a true structural sense, the problem would not be limited to your treasury holdings. It would be a global financial event. So in practical terms, treasuries are one of the lower risk dollar assets. But they have limits. If you buy a treasury security, your principal does not grow like a business can grow. You lend $100 and you receive interest on that $100. If you hold to maturity, you expect your principal back. But the principal itself is not compounding as a company's earnings might compound. That means treasury income is useful, but it is not a powerful growth engine by itself. It can help you generate income. It can help stabilize part of your portfolio. It can help you avoid taking too much risk with money that you may need soon, but it will not usually make you wealthy quickly. That is the trade-off. Lower risk usually means lower expected return. This is one of the first principles of investing. If you want more return, you usually must accept more risk, more volatility, less certainty, more work, or a longer time horizon. People who ignore that principle are usually drawn into bad decisions. They look for high income with low risk, and eventually they discover that the risk was hidden. Treasuries can be bought directly from the government through Treasury Direct or indirectly through funds and ETFs that hold short-term treasuries. A short-term treasury ETF can pay income monthly and be easier for many people to use than buying securities directly. But it is still a security. It is not a bank account. It can fluctuate, it has fund structure, it has an expense ratio, and the income will change when interest rates change. That is important. If the Federal Reserve cuts rates, short-term treasury yields usually decline. The income you are receiving can fall. That means a person depending entirely on short-term treasury income must understand that the income is not permanently fixed. This is the first lesson about replacing a paycheck. A paycheck may feel fixed until the job is lost. Investment income may feel passive until the income changes. Both have risk. The difference is that assets can be diversified and built over time. A job is often concentrated in one employer, one industry, and one human body. Treasuries can be a foundation, but they are not the whole building. The second asset category is dividend, paying ETFs. This is where you move from lending money to owning pieces of businesses. A profitable company can take its earnings and use them in different ways. It can reinvest in growth, it can buy back shares, it can pay down debt, it can acquire other companies, or it can distribute part of those profits to shareholders in the form of dividends. When you own a dividend paying stock, you own a claim on part of that business. If the business earns profits and the board chooses to pay dividends, you receive income. That sounds simple, but the risk is that individual companies can weaken. A restaurant chain can lose customers, a bank can make bad loans, a telecom company can take on too much debt. A consumer company can mismanage its brand, a management team can destroy value, a company can cut its dividend, a stock can fall sharply. If you rely on one company for income, you are taking company-specific risk. That may be acceptable if you know the business deeply, but many people do not. They buy a stock because the yield looks high, and they do not understand why the yield is high. A very high dividend yield is often not a gift. Sometimes it is a warning. The market may be saying that the dividend is not sustainable, the business is deteriorating, or the balance sheet is under pressure. If the company cuts the dividend, the income falls and the share price may fall too. That is the double pain income investors must avoid. This is why dividend ETFs can make sense for many people. Instead of relying on one company, an ETF owns a basket of companies. If one company struggles, the fund can reduce or remove it according to its rules. You receive diversified exposure to many businesses. The work is outsourced to the index methodology and the fund structure that does not eliminate risk. It reduces one type of risk. A dividend ETF can still fall in value. Dividends can still decline. The underlying companies can still suffer in recessions. Interest rates can affect dividend stock valuations. Sector exposure matters, fund methodology matters, but for many investors, a diversified dividend ETF is easier and more robust than trying to pick individual dividend stocks without the time or skill to monitor them. There are different types of dividend ETFs. Some focus on dividend aristocrats, companies that have increased dividends for long periods. The idea is that a company that has raised dividends for decades may have a durable business, disciplined management, and a shareholder-friendly culture. Other ETFs focus on broad high-dividend U.S. companies. These may offer a higher yield than dividend growth funds, but the quality of the underlying holdings matters. A good dividend strategy should not chase yield alone. It should look at profitability, balance sheet strength, cash flow, dividend sustainability, and the ability to keep operating through economic cycles. There are also international dividend ETFs. These can provide income from companies outside the United States. They may offer higher yields, different sector exposure, and currency diversification. They can also expose you to foreign currency movements, political risks, different accounting standards, and different economic cycles. That does not make them bad. It means you must understand what role they play in a world where the United States may not always outperform every other market. International dividend exposure can be useful. It can provide geographic diversification and income, but it should be sized thoughtfully. Then there are real estate investment. Trust ETFs. REITs give you exposure to real estate without directly buying and managing property. Some REITs own physical properties such as apartments, warehouses, cell towers, hotels, offices, or data centers. Others are mortgage REITs that invest in real estate debt. These are very different equity. REITs are connected to property income, rents, occupancy, property values, and interest rates. Mortgage REITs are more connected to borrowing costs, spreads, mortgage performance, leverage, and credit conditions. They can pay high dividends, but the risk can be higher and the income can be more volatile. This is why the dividend number alone is not enough. If one fund pays 4% and another pays 9%, the 9% fund may look better. But the correct question is not simply which pays more. The correct question is, what risks am I taking to receive this income? Income is only valuable if the capital base supporting it is reasonably durable. If you receive a high dividend, but the asset falls dramatically, you may not be better off. This is one of the great traps of income investing. People become obsessed with yield and forget quality. Quality matters more than yield over time. A lower yield from a strong asset can be better than a higher yield from a weakening asset. The goal is not to maximize income this month. The goal is to build income that can survive. The third asset is real property. This is where the income conversation becomes more powerful but also more demanding. Real estate has made many people wealthy because it combines several forces. It can produce rental income. It is a hard asset. It can be financed with debt. It can benefit from inflation over time. It can offer tax advantages. It can appreciate in value. And if managed well, it can create a relatively steady stream of cash flow. But real estate is not passive in the simple way people imagine. A rental property is a business. Tenants move in and out, roofs age, toilets break, insurance premiums rise, property taxes rise, local governments change rules, vacancies happen. Bad tenants happen, repairs cost more than expected. Interest rates affect financing. Property managers must be chosen and monitored. If you do not know your numbers, real estate can punish you. This is why I would never look at real estate only through the purchase price or the rent. You need to understand net operating income. Gross rent is not income. It is the starting point. From gross rent, you subtract property taxes, insurance, repairs, maintenance, management fees, vacancy reserves, utilities if applicable, and other operating expenses. What remains before debt service is net operating income. If you buy the property all cash, your return can be measured by comparing annual net income to the total acquisition cost. If you buy a $200,000 property and after expenses it produces $10,000 a year, that is a 5% unlevered return before considering appreciation, tax effects, and other factors. Is that good? It depends. Compared to treasuries, Maybe it is not attractive enough if treasuries pay a competitive rate with less work and less risk, compared to a property with stronger growth prospects. Maybe it is too low compared to a fully passive investment. You must account for the work and the headaches. A serious real estate investor sets a required return. If you require 7% cash, on cash or unlevered yield, you do not buy a property that produces 5% unless there is another reason, such as strong appreciation, potential value, added opportunity, or strategic importance. The numbers must drive the decision, not emotion, not the appearance of the house, not the idea that real estate always goes up. Real estate can be excellent, but only if the deal works. This is another principle that applies across investing. A great asset at the wrong price can be a poor investment. A difficult asset at the right price can sometimes be attractive. Price matters, cash flow matters, debt terms matter, local market matters, management matters, taxes matter. People are often attracted to real estate because of leverage. They can buy a property with a down payment and finance the rest. If the property appreciates and the rent covers expenses, leverage can amplify returns. But leverage also amplifies risk. If income falls, expenses rise, or debt costs increase, the investor may be squeezed. A property that looked profitable at one interest rate can become much less attractive at another. A vacancy can hurt more when debt payments continue. Repairs can create stress when reserves are too low. This is why you must not buy real estate with thin margins. The deal needs a margin of safety. A property should be able to survive vacancy, repairs, and unexpected expenses if everything has to go perfectly for the deal to work. The deal is too fragile. Real estate also has tax advantages, which can be significant. Depreciation allows you to deduct a portion of the building's value over time because the structure is assumed to wear out. There may be ordinary and necessary business expenses. There may be ways to offset income legally depending on your situation, classification, and the tax rules that apply. But taxes are complex. You need a good accountant. The tax code can make real estate powerful, but tax benefits should not turn a bad deal into a good one. First, the economics must work. Then the tax structure can improve the outcome. That order matters. Do not buy a weak investment for a tax deduction. That is like spending $1 to save a fraction of a dollar. Good tax planning improves good investing. It does not rescue bad investing. Real estate is especially good for people willing to do work, build systems, understand local markets, and manage operations. It is less good for people who want pure passivity and have no interest in learning. You can hire property managers, but hiring a manager does not eliminate responsibility. It changes the work from managing tenants to managing the manager. That can still be worth it, but it is not nothing. The fourth asset is business ownership. This is where the biggest wealth can be created, but also where the most confusion exists. There is a major difference between being an employee in a business and being an owner of a business. An employee earns wages. An owner has a claim on profits. In a simple example, if a business generates $1,000,000 in revenue and has $600,000 in expenses, then $400,000 remains as profit before taxes and distributions. That profit belongs to the owners according to their ownership structure. That is the power of equity. The owner participates in the surplus created by the system. But business ownership is hard, very hard. People underestimate it because the internet makes business sound easy. Buy a laundromat, buy a car wash, buy a vending machine route, start an online store, buy a small company, hire someone to run it, collect the profits. That is a nice story. Reality is more demanding. Customers must be acquired, employees must be managed, costs must be controlled, products must be delivered. Competition responds. Systems break, margins get squeezed, cash flow becomes uneven. A bad hire can damage the business. A bad lease can destroy profits. A bad operator can ruin the asset. A bad industry can trap good effort. Business ownership can create enormous income, but the risk is operational. If you start your own business, you may need years of work before it pays you. You may not be passive at all. You may work harder than you did at your job. You may earn less at first. You may fail. Many businesses do. If you buy a small business, you may discover that the previous owner was the business. The customers liked that person. The employees depended on that person. The systems were informal. The profit was not as stable as it looked. Once the owner leaves, the business changes. This is why buying a business requires deep due diligence. You must understand revenue quality, customer concentration, employee dependence, supplier risk, lease terms, debt, working capital needs, capital expenditures, seasonality, margins, owner add-backs, legal liabilities, competitive position. Whether the business can run without you. If a small business only works when you are working inside it every day, then you may have bought yourself a job that may still be valuable if you want to operate it and build it. But it is not passive income. True passive ownership usually requires either a larger business, a professional management team, a minority investment in a business you trust, or enough capital to buy systems rather than buy tasks. That is why business ownership is powerful but not easy. It can replace a paycheck. It can also create a more demanding paycheck until the system is built. This is where many people get humbled. They ask, how hard could it possibly be? That question has destroyed more capital than many people realize. Business looks simple from the outside because the customer sees only the product or service. The owner sees everything behind it: people, process, risk, regulation, inventory, cash flow, sales, marketing, taxes, technology, operations, and stress. If you are the right person, business can be the greatest wealth building tool in the world. If you are the wrong person or you buy the wrong business, It can become a financial and emotional burden that does not mean avoid business. It means respect it. Business ownership is not a shortcut. It is a skill game. The fifth asset is private credit or peer-to-peer lending. This means lending your money to someone else who needs capital. Often outside the traditional bank system, the borrower might need money for real estate, a business, a personal loan, or a project. In exchange, you receive interest. The attraction is obvious. The rates can be higher than treasuries or bank savings. Some private loans can pay 8%, 10%, 12%, or even more. For someone trying to replace a paycheck, that sounds very attractive. But higher interest exists for a reason. The borrower is paying more because the loan carries more risk, is less liquid, is harder to underwrite, or cannot be financed cheaply through traditional channels. This does not make it bad. It means you must understand the risk. If you lend money privately, the central question is repayment. How will the borrower pay you back? What collateral backs the loan? What is the loan to value ratio? What happens if the borrower defaults? What legal rights do you have? How quickly can you recover collateral? Are you senior or junior in the capital stack? Who services the loan? What fees are involved? What is the borrower's track record? What is the platform's underwriting process? What happens if the platform fails? A high interest rate without strong underwriting is not income. It is a warning. Private credit can be powerful when secured by good collateral, structured properly, and diversified. Real estate hard money lending is one example where borrowers may pay high rates because they need speed and flexibility. If the loan is secured by a property with a conservative loan-to-value ratio, the lender may have some protection. But protection is not the same as certainty. Collateral can fall in value. Foreclosure can take time. Legal costs can be high. Borrowers can misrepresent facts. Platforms can fail. Economic downturns can increase defaults. This is why I would treat private credit as more advanced. It may create income, but it requires skill, discipline, and a strong understanding of risk. If you do it casually because the yield looks high, you may be lending to the wrong people at the wrong time with weak protection. That is not income investing, that is reaching for yield. Reaching for yield is one of the most common ways people lose money. When safe assets pay low rates, investors reach for higher income, they buy riskier bonds. Private loans, high-yield funds, mortgage REITs, or complex structures. They focus on the yield and ignore the downside. Then a downturn arrives and they discover that the yield was compensation for risk they did not understand. This is why replacing a paycheck must be done carefully. You are not trying to create the highest possible income number. You are trying to create sustainable income. Sustainable income comes from assets that can survive. Now let us connect the 5 asset categories. Treasuries provide stability and relatively predictable income, but limited growth. Dividend ETFs provide ownership in businesses and diversified income, but with market volatility. Real estate provides cash flow, hard asset exposure, leverage potential, and tax benefits, but requires work and local knowledge. Business ownership provides profit participation and potentially large income, but requires skill, operations, and risk. Taking private credit provides interest income, sometimes high, but requires underwriting and risk control. Each category has a place. Each category has failure modes. The best strategy is not to idolize one asset. The best strategy is to understand the role of each. If you are at the beginning, treasuries and dividend ETFs may be easier. You can start with smaller amounts. You can learn, you can build habits, you can reinvest income. If you have more capital and a willingness to work, real estate may become attractive. It can create income and tax advantages, but it demands discipline. If you have entrepreneurial skill or the desire to operate a business can be the largest opportunity, but it can also be the hardest. If you understand lending and collateral, private credit can add income, but it should not be done blindly. This progression matters. Do not start with the hardest thing because the internet made it sound glamorous. Start where your capital, skill, temperament, and time fit. That is how good systems are built. The common mistake is to think about income assets only by yield. Someone says treasuries pay a certain percent, a dividend ETF pays another percent, a mortgage REIT pays more, a private loan pays even more. A business might produce much higher returns. Real estate might produce cash flow and appreciation. Then people chase the biggest number that is wrong. Yield without risk analysis is dangerous. You must ask what sits underneath the yield. Is the income contractual or discretionary? Is it backed by the government, businesses, property, borrowers, or operations? Can it be cut? Can the asset lose value? Can the borrower default? Can expenses rise? Can taxes change? Can interest rates change? Can liquidity disappear? Can you hold through volatility? Can you manage the asset? Can you replace the manager? Can you understand the documents? Can you survive a bad year? These questions matter more than the headline yield. An income stream that fails when you need it most is not freedom. It is fragility disguised as freedom. The entire goal of replacing a paycheck is to become less fragile, not more. This means you need to build income in layers, a base layer of safe liquidity and lower risk income, a business ownership layer through broad dividend ETFs or high-quality companies, a real asset layer through real estate or REITs, an entrepreneurial layer through a business if you have the skill and temperament, a credit layer through private lending only if you understand underwriting. And above all, a discipline layer, because without discipline, the assets do not matter. You can ruin any strategy with bad behavior. You can overpay for real estate. You can buy high-yield junk. You can borrow too much. You can buy a business. You do not understand. You can lend money without collateral. You can quit your job before the income is reliable. You can spend the cash flow instead of reinvesting it early. You can underestimate taxes. You can ignore inflation. You can assume passive income means no work. That last one is especially important. Passive income is often not passive at the beginning. It becomes more passive after systems are built. Treasuries are close to passive. Dividend ETFs are mostly passive. REITs are passive in structure but volatile in market value. Rental property is not fully passive unless managed well, and even then oversight is required. Business ownership can be active for years before it becomes passive. Private credit may be passive after the loan is made, but underwriting and monitoring are not passive. So when someone says they want passive income, I ask what they really mean. Do they want income without a job? Do they want income without work? Do they want income without risk? Those are different things. Income without a job is possible. Income without any work is harder. Income without risk does not exist. The mature goal is to reduce dependence on active labor while accepting the responsibility of owning assets. Ownership is not magic. Ownership is responsibility. If you own assets, you must understand them. Now let us think about the math. If you want $80,000 a year in investment income, the amount of capital required depends on the yield. At a 4% yield, you need $200,000. At a 5% yield, you need $160,000. At an 8% yield, you need $100,000. At a 10% yield, you need $800,000. But the higher the yield, the more you must ask whether it is sustainable and what risk you are taking. This is why the income goal can feel discouraging. Most people do not have $100,000 or $200,000 sitting idle. But the purpose of the math is not to discourage you. It is to make the system real. You build toward the number over time. You may not replace the whole paycheck at once. First, assets pay the phone bill, then the utilities, then the groceries, then the mortgage, then part of the lifestyle. Eventually, if you are disciplined enough for long enough, the assets can cover everything. That is how financial independence is usually built, gradually, not dramatically. This is why reinvestment is so important in the early years. If you take every dollar of income and spend it, the income may not grow fast enough. If you reinvest dividends, rental cash flow, interest, and business profits, you compound. Your assets buy more assets. Those assets produce more income. The system begins to feed itself. Compounding feels slow at first, then it becomes powerful. Most people quit during the slow part. They never reach the powerful part. That is why behavior matters more than intelligence. You do not need to be a genius to build income assets. You need to be consistent, patient, skeptical of shortcuts, and willing to learn. You need to avoid big mistakes. A person who avoids big mistakes and keeps buying quality income, producing assets for decades, can do very well. A person who chases every high-yield idea may lose years of progress in one bad decision. The big mistakes are often avoidable. Too much leverage, no reserves, chasing yield, buying things you do not understand, confusing revenue with profit, ignoring taxes, ignoring maintenance, ignoring vacancy, ignoring management, ignoring liquidity, ignoring concentration, quitting work too soon, assuming passive income is guaranteed. These are not sophisticated errors, they are basic errors, but basic errors repeated with real money are very expensive. Now let me return to the 5 assets in the original sequence and reframe them as stages of difficulty. Treasuries are the easiest because the structure is simple. You lend to the government and receive interest. The income depends on rates. The principal does not grow much. The role is stability and income. Dividend ETFs are slightly more advanced because you own businesses. The income can grow over time if the businesses grow and dividends grow, but the market value can decline. The role is income plus potential growth. Real estate is more advanced because you own and operate a local economic asset. The income can be strong and tax benefits can help, but the work and risk are higher. The role is cash flow, hard asset exposure, and inflation participation. Business ownership is more advanced because you own an operating system. It can produce the greatest income, but it requires skill, management, and risk tolerance. The role is profit ownership and scalable wealth creation. Private credit is advanced because you are underwriting someone else's need for capital. It can produce high income, but default risk and collateral analysis matter. The role is credit income, but only with strong risk controls. This is a practical ladder. You do not need to climb every rung. Some people should never own rental property. Some people should never buy a business. Some people should not lend privately. That is fine. A good financial plan fits the person. It does not impress the internet. If you are busy, inexperienced, and risk-averse, broad dividend ETFs and treasuries may fit better than rentals or small business acquisitions. If you are entrepreneurial, operating a business may be your best path. If you understand real estate and enjoy systems, rental property may be powerful. If you are experienced in underwriting and legal structure, private credit may work. If you want simplicity, a mix of index funds, dividend ETFs, and treasuries may be enough over a long period. There is no shame in simple done consistently often beats complex done badly. The purpose is to build reliable income, not to look sophisticated. Another important point is taxes. Investment income is not all taxed the same way. Treasury interest has one tax profile, qualified dividends have another, REIT dividends often have different treatment, rental real estate can have depreciation and expense deductions. Business income has its own rules. Private interest income has another tax profile. Taxes can change the real income you keep. That is why the pre-tax yield is not the final answer. you must think about after-tax income. A 5% income stream with favorable tax treatment may be better than a 7% income stream with worse risk or worse tax treatment. Real estate may produce accounting losses while generating cash flow because of depreciation. A business may allow certain deductions but also require payroll taxes, compliance, and reinvestment. A good accountant can matter a great deal. Not to create tricks, to make sure the system is understood and legal. Taxes are part of the machine. Ignoring them is not wise. Inflation is another part of the machine. If your income does not grow over time, inflation can weaken your freedom. An $80,000 lifestyle today may cost more in the future. If your income stream is fixed, you may feel free today and squeeze later. That is one limitation of fixed income assets. Treasuries can pay income, but the income may not grow unless rates rise. If inflation is high and rates lag, real purchasing power can decline. Dividend-growing companies and real estate may have better inflation characteristics. If earnings and rents rise over time, businesses can sometimes raise prices. Real assets can participate in inflation, but none of this is automatic. This is why the income portfolio should not only produce income today, it should have some ability to grow income over time. A portfolio built only for current yield can become weaker each year. A portfolio built for durable and growing income can become stronger. That is the difference between income and financial independence. Financial independence requires that income survives time. Now let us talk about sacrifice. The source argument correctly says this is not easy. Most people want the output without the input. They want investment income but do not want to save aggressively. They want assets but do not want to reduce spending. They want freedom but do not want delayed gratification. They want passive income but do not want to build capital. That cannot work. If you spend everything you earn, you will not build the assets that replace what you earn. This is a simple equation, and people try to avoid it because it is uncomfortable. Income minus spending equals capital available for investing. If that number is small, the asset base grows slowly. If that number is large, the asset base grows faster. You can increase income, you can reduce spending, you can do both, but something must create investable capital. There is no asset strategy that substitutes for never saving. The first asset is not a treasury, an ETF, a property, a business, or a loan. The first asset is the gap between what you earn and what you spend. Without that gap, nothing else begins. This is why replacing a paycheck requires behavior change before investment selection. People want to ask which asset to buy. The better first question is how much money can be consistently moved from consumption into ownership. Once that habit exists, the asset selection becomes powerful. Without that habit, asset selection is just entertainment. Now imagine building the system over time at first. You buy short-term treasuries or a treasury ETF to create a small monthly income stream. It is not enough to live on, but it teaches you that money can pay you. Then you buy dividend ETFs. The dividends are small at first, but they arrive, you reinvest them, the share count grows, the income grows, then perhaps you buy a rental property. It is not easy. You study markets, you learn expenses, you learn management, you make mistakes. But if done well, a new income stream begins, then perhaps you start or buy a business. It is hard, you work, you build systems. Over time, the business creates profits that are not limited to your hourly labor. Then perhaps you participate in private credit carefully, lending in a way that is collateral, backed, and diversified. Now income comes from several places: government interest, business dividends, real estate rents, business profits, loan interest. This is stronger than relying only on one paycheck, but it is not automatic. It must be built. And because it must be built, the investor must become a builder. That is the mindset shift. Most employees are trained to receive income. Owners are trained to create systems that produce income. If you want to replace your paycheck, you must move from employee thinking toward owner thinking. Employee thinking asks, how much will I be paid? Owner thinking asks, what asset or system produces this cash flow and what risks could disrupt it? Employee thinking asks, can I afford the payment? Owner thinking asks, does this asset generate net cash after all expenses? Employee thinking asks, what is the income? Owner thinking asks, is the income durable, growing, and properly priced? Employee thinking asks, how much can I spend? Owner thinking asks, how much can I reinvest? This is a different way of seeing the world. It is not just about money, it is about control. A person with only a paycheck has one income source. A person with assets has multiple claims on economic production. That is financial resilience. But with resilience comes responsibility. You cannot outsource all thinking. Even if you use ETFs, property managers, accountants, business operators, or lending platforms, you still must understand the role of each asset and the risk behind it. Never blindly trust a person on the internet. Never buy something only because it pays income. Never assume that a fund name explains the fund. Never assume that a property will cash flow because rent seems high. Never assume that a business profit is real until you understand the financial statements. Never assume that a borrower will repay because the interest rate is attractive. Do the work. If you do not want to do the work, keep the system simpler. That is perfectly acceptable. A simple plan that you understand is better than a complex plan you cannot manage. This is where many people get hurt. They believe financial freedom must look impressive. They want many properties, private deals, businesses, exotic income streams, and high yields. They do not realize that every additional asset type adds another system to manage. Complexity can be an asset if you are skilled. Complexity can be a liability if you are not. For most people, the path should begin with simplicity. A strong emergency fund, no toxic debt, consistent investing, broad market exposure, treasuries or cash equivalents for stability. Dividend ETFs if income is a priority, then, only when ready, real estate, business ownership, or private credit. The order matters because each stage teaches discipline. If you cannot manage a simple portfolio, do not assume you can manage tenants. If you cannot read an ETF fact sheet, do not assume you can buy a business. If you do not understand credit risk, do not lend privately because the yield looks good. Skill must grow with complexity. That is the principle. Now, I want to address the idea of never working again. It is emotionally powerful, but it can be misleading. A better goal is not necessarily never working. A better goal is never being forced to work only because you need the next paycheck. That distinction matters. Many people who build financial independence continue to work, but they work differently. They choose projects, they build businesses, they invest, they teach, they create, they spend more time with family. They stop tolerating unhealthy jobs. They have options. The real asset is optionality. When investment income covers your basic needs, your relationship with work changes. You can still work, but work becomes choice rather than dependency. That is a healthier frame. If you define success as never doing anything again, you may become disappointed. Human beings need purpose, but if you define success as owning enough income, producing assets to choose how you spend your time, then the goal is much more durable. Money should buy freedom, not emptiness. Assets should give you choices, not just payments. That is why I would build the system slowly and thoughtfully. Do not rush to quit your job because your assets produced income for a few months. Income must be tested. Markets go down. Tenants leave. Businesses have bad quarters. Borrowers default. Dividends get cut. Interest rates change. You need a margin of safety. If your annual spending is $80,000, having exactly $80,000 of expected investment income may not be enough. Taxes, inflation, healthcare, repairs, emergencies, and volatility all matter. A stronger system produces more than the minimum, holds reserves, and has flexibility. Freedom without a margin of safety is fragile. A job replacement plan should include buffers, cash reserves, diversified income, low fixed expenses, no high interest debt, insurance. Tax planning, a plan for bad years, a plan for reinvestment. That is how you turn income into resilience. Now let us look at each asset in terms of what can go wrong. Treasuries can produce less income if rates fall. Long-term treasuries can lose market value if rates rise. Inflation can reduce real returns. Government debt and currency risk exist over long periods. Dividend ETFs can fall in market value. Dividends can be cut. Sector concentration can matter. A fund's methodology may not fit your goals. High yield can hide weak fundamentals. Real estate can suffer vacancies. Repairs, bad tenants, falling property values, rising insurance, rising taxes, changing local laws, and financing risk. Businesses can face competition, management problems, falling demand, cost increases, lawsuits, employee issues, customer concentration, and cash flow stress. Private credit can face defaults, weak collateral, fraud, platform risk, legal delays, illiquidity, and economic downturns. This may sound negative, but it is not. A risk named is a risk you can manage. An unnamed risk manages you. That is why clear thinking is valuable. If you know treasury income can fall, you do not rely on it blindly. If you know dividends can be cut, you diversify. If you know real estate has expenses, you underwrite them. If you know business is hard, you build systems. If you know private credit can default, you demand collateral and diversify. This is the difference between optimism and naivety. Optimism says, this can work if I do the right things. Naivety says, this will work because I want it to. I prefer optimism with risk control. Replacing a paycheck requires both. It requires belief that you can build something better, and it requires humility about what can go wrong. Now let us think about the role of broad market investing. Because the original argument says many advisors tell people to buy the S&P 500, that is not bad. In fact, for wealth building, broad market investing can be excellent, but there is a difference between wealth accumulation and income replacement. An S&P 500 index fund may grow wealth over time, but its dividend yield may not be enough to cover living expenses to live off it. You may need to sell shares periodically. That can work under a total return strategy, but it is psychologically and operationally different from living off income. Some people prefer cash flow assets because the income arrives without selling principal. That preference is understandable, but you should not assume income investing is automatically better than total return investing. Sometimes a lower yielding asset with higher growth can create more wealth and more future income than a high yielding asset with no growth. The best approach may combine both: growth assets to build wealth, income assets to create cash flow, stable assets to reduce volatility, real assets to hedge inflation. Business ownership for upside. The mix changes with stage of life. A young person may prioritize growth. A person approaching financial independence may prioritize income stability. A retiree may prioritize preservation, inflation protection, and reliable cash flow. There is no single answer for all people, but the principle remains: assets must eventually support expenses if freedom is the goal. That means the portfolio must be built not only for a number on a screen, but for real life cash needs: rent, food, healthcare, insurance, taxes, family support, travel, emergencies, inflation. The asset system must meet life. That is what a paycheck currently does. The new system must replace that function. Now, I want to make the ending practical. If you are starting from zero, do not begin by asking how to make $80,000 a year passively. Begin by asking how to create the first $100 a month in asset income. That first $100 matters. It changes how you see money, then build to 500, then 1,000, then 2,000. Then more. Each step teaches you. You learn how interest works. You learn how dividends work. You learn how market prices move. You learn how taxes affect income. You learn how real estate numbers work. You learn how businesses generate profit. You learn how credit risk works. You become more skilled as the income grows. This is better than trying to jump directly into advanced strategies before you have the foundation. Financial freedom is built by accumulating skills and assets together. If assets grow faster than skill, risk increases. If skill grows with assets, the system becomes stronger. That is why education matters. Not education in the academic sense only, education in the practical sense. Read statements, understand yields, study fund holdings, learn tax basics, learn real estate math, learn business accounting, learn credit risk, learn how to think in probabilities, learn how to avoid emotional decisions. The more you understand, the less dependent you are on other people's opinions. That is important because the world is full of people selling income dreams. Some are useful, some are dangerous. Your protection is understanding. When you understand the mechanics, you can evaluate claims. If someone says a fund pays a high yield, you ask where the yield comes from. If someone says a property cash flows, you ask after which expenses. If someone says a business is passive, you ask who operates it. If someone says a loan pays 15%, you ask what collateral exists and why the borrower is paying that much. If someone says you can quit your job soon, you ask what happens in a bad year. Questions protect capital. The better your questions, the safer your path. Now let me bring it back to the core message to replace a paycheck. You need assets that pay you. Treasuries can pay you interest. Dividend ETFs can pay you distributions from businesses. Real estate can pay you rent after expenses. Businesses can pay you profits. Private credit can pay you interest from borrowers. Each income stream is different. Each has a role. Each has risk. The goal is to build a diversified income machine that can eventually cover your life. But the machine takes time, it takes capital, it takes sacrifice, it takes discipline, it takes learning, it takes not being seduced by shortcuts. That may sound less exciting than a promise of instant passive income, but it is much more useful. The world rewards people who understand how money works. It punishes people who only want outcomes. If you want income without working forever, then work now to acquire assets. Work now to understand them. Work now to build the gap between what you earn and what you spend. Work now to reinvest. Work now to avoid foolish risks. The irony is that the path to not needing a paycheck often requires a period of serious effort. But that effort is different from ordinary labor. Ordinary labor is spent and gone. Asset building effort can compound. That is why it is worth doing. A paycheck feeds today, an asset can feed tomorrow. A portfolio of assets can feed decades. And if built properly, it can also give you something more valuable than income. It can give you control over your time. That is the true objective. Not to never work, not to impress anyone, not to chase the highest yield, not to own the most complicated portfolio. The objective is to build a life where your basic needs are paid for by assets you understand and control so that your time is no longer owned completely by the next paycheck. That is freedom. And freedom is not created by one asset, it is created by a system. Start with the safest and simplest assets if that is where you are. Move into more complex assets only when your knowledge and capital justify it. Respect risk, demand quality, do not chase yield, do not ignore taxes, do not underestimate work. Do not confuse income with sustainability. Do not quit before the system is durable. Build slowly. Reinvest consistently. Let compounding help you. And remember that every dollar you move from consumption into ownership is a dollar that may one day work so that you do not have to. That is how a paycheck is replaced. Not overnight, not by luck, not by copying a stranger blindly, by understanding the assets, respecting the risks, and building the income machine one layer at a time.